Volkswagen just canceled plans for a major manufacturing facility in the United States. Not delayed, not under review, completely canceled. The CEO told Handelsblatt that Trump's tariffs have already cost the company 2.1 billion euros. That is roughly $2.5 billion evaporated in just the first 9 months of 2025. And his message was blunt. He said, given the current tariff burden, large additional investments simply cannot be funded. Now, you see headlines like this all the time, but you need to understand the difference between corporate speak and corporate action. In the corporate world, you pause when you're uncertain. You review when you're negotiating, but you cancel publicly and totally only when the spreadsheet is bleeding red. This isn't a negotiation tactic. This is a vote of no confidence. This is the moment one of Europe's largest industrial titans publicly walks away from American expansion. And cancellations like this don't happen in isolation. They are symptoms of something much larger breaking in the global financial plumbing. This is about more than just cars. It is about the disintegration of the transatlantic economic bridge that has held the West together since 1945. I work in finance, where spotting geopolitical patterns is the job. And right now, the data is screaming a pattern that most analysts are missing. America's tariff strategy is achieving the exact opposite of its stated goals. It was supposed to force companies to build here. Instead, it is forcing them to leave. Here is the financial mechanism that is driving capital out of the United States. Let's look at the math Volkswagen was looking at. Because the original calculus was actually very straightforward. Since 2018, Volkswagen had been eyeing a second U.S. manufacturing site. The prize was an Audi production facility. This wasn't idle speculation. They were serious. According to Detroit News, Volkswagen already operates in Tennessee, where they build the ID.4 and the Atlas. They are currently constructing a $2 billion plant in South Carolina for the Scout Motors brand. And crucially, they owned a large plot of land in South Carolina, specifically earmarked for this potential Audi expansion. Multiple U.S. states were competing with incentive packages to attract this investment. The logic was simple. Subsidies under the Biden administration, specifically the Inflation Reduction Act, made the investment economically viable. And building locally would insulate Audi from import duties. Unlike BMW or Mercedes-Benz, which build their popular SUVs right here in the United States, Audi produces key models like the Q5 SUV at its Mexico plant. Those vehicles don't qualify for duty-free imports under the current structures. So a U.S. factory would solve that problem. It was a hedge against trade friction. But then the equation changed. Trump's tariff regime didn't just tweak the margins, it broke the model. Volkswagen currently faces total U.S. tariffs of 27.5%. That's the new 25% auto tariff stacked on top of the pre-existing 2.5% rate. Volkswagen CEO Oliver Blume put it politely. He said talks were fair and constructive, but they couldn't overcome the fundamental math problem. Translate that. Think about the profit margins in the automotive industry. Mass-market car manufacturers typically operate on margins of 6% to 8%. Premium brands like Audi might push that to 10% or 12% in a good year. When you introduce a 27.5% tariff on your revenue line, you aren't just eating into your profit, you are wiping it out 3 times over. And when you are losing $5 billion a quarter to tariffs, every dollar you commit to new capital expenditure has to clear a much, much higher hurdle rate. You have to justify building a factory, hiring workers, and buying robots in a market that is actively penalizing you. And here is the kicker. According to CarScoops, Audi is currently eating most of those tariff costs rather than passing them on to consumers to maintain market share. That means every vehicle sold in America is essentially a loss leader. This is about opportunity cost. When you are hemorrhaging that kind of money, you don't double down on the market causing the bleeding. You stop the bleeding. This is why the cancellation of the Audi plant is so significant compared to the Scout Motors plant. They are proceeding with Scout because it's a new brand, built on trucks and SUVs, targeting a specific American niche with potentially higher margins that can absorb the shock. But for a global brand like Audi, dependent on a complex supply chain of imported parts, the tariff wall makes the math impossible. The official narrative from the Trump administration is that tariffs act as leverage. The theory is that we have the biggest market, so if we charge you to enter, you will build factories here to avoid the charge. That theory assumes companies are desperate for access. It assumes they have no other choice. But the data shows something else. It shows that when the cost of access becomes unpredictable, companies don't respond by accepting your terms. They respond by reducing their exposure to you entirely. VW looked at the 27.5% tax. They looked at the policy volatility, and they decided that the advantage of being in the U.S. market was no longer worth the price of admission. That is the headline. Now look at the spreadsheet. If this was just Volkswagen, you could write it off as a bad quarter for one car company. You could argue that maybe their product mix was wrong or their strategy was flawed. But it's not just them. Volkswagen isn't making this decision in a vacuum. They are part of a mass retreat. According to Reuters, German investment into the United States collapsed 45% year over year in 2025. Let that number sink in. 45%. We are talking about a drop from 19 billion euros down to 10.2 billion euros in under a year. That is nearly half of the investment pipeline gone. And a joint report from Deloitte and the Federation of German Industries found that 1 in 5 German manufacturing firms have already shifted production abroad. They are moving away from the US and Europe. That represents an increase of 8 percentage points in just 2 years. Why? This is the mechanic. It's called policy risk premium. In normal markets, companies discount future cash flows using stable assumptions. You assume tax rates might move a few points. You assume labor laws stay relatively consistent. You assume the rules of the game today will roughly be the rules of the game tomorrow. But when trade policy becomes a weapon that swings wildly based on political winds, you can't model that. Here's what outsiders often miss about finance. I can hedge against a 20% cost increase. I can buy futures. I can cut OPEX. I can renegotiate supplier contracts. But I cannot hedge against a president who wakes up on a Tuesday and changes the rules by tweet. Or a trade negotiator who threatens 30% tariffs one week, negotiates it down to 15% the next week in Scotland, and then threatens more duties at Davos the week after that. That's called unmodelable risk. And in finance, unmodelable risk gets a value of 0. It is chaotic, and chaos kills long-term investment. Think about the timeline of a factory. A factory requires a 20 to 30-year payback horizon. You pour concrete today for returns you expect in 2040. If you don't know what the trade rules will be in 20 months, let alone 20 years, you don't build the factory. So this is a quiet exodus. Companies aren't holding press conferences to announce they aren't investing. They aren't issuing press releases saying they don't trust the US anymore. They just don't invest. They silently reallocate that capital elsewhere. The German Economic Institute reports that German exports to the US fell 7.8% in just the first 3 quarters of 2025. But look closer at the sectors. Auto exports down 17.5%, machinery down 9%, chemicals down over 10%. These are the heavy industries. These are the sectors that require massive capital outlays and long-term planning. These are the sectors that account for over 40% of German exports to America, and they are pulling back. And here is the part that hits home for the American economy. This cancellation affects America's own industrial capacity. When Volkswagen cancels an Audi plant in the US, that's thousands of American jobs that won't be created. But it's deeper than that. It's the suppliers who won't build adjacent facilities. It's the logistics companies that won't buy new trucks. It's the tax revenue that won't materialize for state and local governments. The states that were competing to attract Volkswagen's investment, South Carolina, Tennessee, they aren't getting a consolation prize. They are getting nothing. Those jobs simply evaporated before they were even created. So if the capital is leaving the U.S., where is it going? Because capital hates a vacuum. It has to go somewhere. This is where the geopolitical reality checks in, and it is uncomfortable. According to Yahoo Finance data, China is about to replace the United States as Germany's most important trading partner. Total trade with Beijing over the first 11 months of 2025 hit 231 billion euros. With the U.S., 222 billion euros. Think about the irony here. For years, the U.S. has been pressuring allies like Germany to de-risk from China, to pull away from Beijing because of geopolitical concerns. And Germany wanted to do that. German executives aren't blind. They know the risks of relying on China. They know the IP theft risks. They know the geopolitical tension. But right now, American policy volatility is making China look like the stable option. Economist Sebastian Julian warned recently that the U.S. market is becoming risky business for German exporters. Companies don't make 20-year bets in risky business markets. They make them in predictable ones. And right now, despite everything, Beijing's industrial policy looks a lot more predictable to a German CFO than Washington's does. But it's not just China. The capital is finding other homes too. We are seeing a massive pivot towards India. This is the piece of the puzzle that often gets ignored. Ursula von der Leyen recently called the new EU-India deal the mother of all deals. This isn't just diplomatic fluff. This is a structural realignment. German traders are explicitly stating they are looking for alternative sales markets. They are diversifying away from the United States. Specifically, German machinery exports to India have surged as companies look for a manufacturing base that offers scale without the tariff headache of the U.S. or the geopolitical baggage of China. We are watching a self-reinforcing cycle. As European companies reduce their U.S. exposure, they have less stake in the transatlantic relationship. Less economic tie means less political alignment. We're going to see this play out in everything from technology standards to financial regulations to security commitments. The economic coupling that made the Western alliance durable for 75 years is being unwound. Not by enemies, but by allies who can no longer trust the spreadsheet. The German Wholesale and Foreign Trade Association president, Dirk Jandura, put it bluntly. He said, "The United States remains a very important market for us, but nothing lasts forever." Nothing lasts forever. That is a warning shot. It signals that the era of American exclusivity is over. German companies are no longer treating the U.S. market as their primary growth engine. They are treating it as a mature, volatile market to be harvested for cash where possible, but not invested in for the future. This analysis is of macroeconomic trends in capital flows, not financial advice. Markets are volatile, and past patterns do not guarantee future outcomes. So what happens next? My prediction is that this is irreversible in the short to medium term. Even if the Trump administration reversed course tomorrow and eliminated every single tariff, Volkswagen isn't going to immediately commit billions to a U.S. expansion. Why? Because the lesson has been learned. They have learned that American trade policy is weaponized. That lesson doesn't get unlearned just because the weapon is holstered for a week. When you work in finance, you know that once policy risk gets priced into investment decisions, it takes years, sometimes decades, of demonstrated stability to remove it. You can destroy trust in a month. It takes a generation to rebuild it. When historians look back at this era, I think the abandoned Audi factory will be marked as an inflection point. The moment when major industrial powers stopped treating American market access as a strategic imperative and started treating it as a risk to be managed. The $2.5 billion that Volkswagen lost to tariffs in 9 months is the cost of one company learning that lesson. But multiply that across Germany's entire industrial base. Then multiply it across Europe, then Canada, then Asia. Then you start to see the scale of what is being lost. We have to understand that American power was never just about the size of its market. It was about being the anchor, the predictable center of gravity for the global financial system. Trust is the only currency that actually matters in global trade. America spent 80 years building the credit score of the world's safe harbor. It took less than a decade to torch it. And once capital learns to leave, it doesn't come back just because you say sorry. The $2.5 billion Volkswagen lost is just the down payment. The real cost is the loss of the alliance itself. Now, speaking of Germany and the United States, there is another massive story developing that connects directly to this. It's about the underlying asset of the global system. Germany is now openly discussing demanding back their gold reserves from the United States. That is a massive signal for the dollar, and it changes the leverage calculation entirely. I've done a full analysis on that specific gold movement. Check the video on your screen right now. Thanks for watching.